We had another mixed day in the S&P, although we do know Tesla investors would have been very happy. They saw their share price go up by around 22%. And today we are focusing on a company that has reported this week, and we believe it to be a great opportunity in the market. And as we can see, just yesterday they were down around 5%. So we're going to talk about KDP. We in fact notice it does get a very rare triple buy right across the board from Seeking Alpha, Wall Street and Quant. We're going to talk about the opportunities we see, the undervaluation, as well as running through the company's metrics and their earnings. Talking of earnings, let's start with that, given they did just recently report. And when we do take a look at the numbers, firstly, in terms of their revenue, they reported $3.89 billion. Now, it was up only 2.3% over the same period last year. And remember, as always, we want a minimum of 3 to 4% just to keep up in line with inflation. Their earnings per share at 51 cents was also a marginal increase from the same quarter last year. Now, in terms of their revenue, it was a marginal miss from what analysts were expecting at $3.92 billion. However, we do note their EPS was pretty much in line. Now, in terms of some very closely watched metrics for this company, we can see that the net sales specifically related to coffee was down $976 million versus the $984 anticipated, so a drop of just under 4% from the same quarter last year. Their international sales, whilst it was down below what analysts targeted, it was a marginal beat in terms of the same comparison. And the refreshment beverages, probably where they did gain a lot in terms of the comparison, up around 5.3%. Now, we also have some very interesting information to report that they just disclosed in their latest quarterly presentation. And as we can see, this was just from yesterday, but they have officially announced the acquisition of Ghost Energy Drink. Now, maybe this is one you heard of, maybe this isn't one, but what we do find interesting, it has around 3% in terms of the energy share market, and definitely something to look very closely to, given the fact that we've seen companies like Celsius report some very large growth, double digits. In fact, when we look specifically at this acquisition, their sales have more than quadrupled over the last 3 years. Whether or not this is a great investment for KDP moving forwards, definitely something interesting and definitely something to keep an eye on. Then in terms of some of the highlights from this latest quarter, their sales are up around 3.1%. They do anticipate that this will increase as well over the next quarter. They also notice an acceleration in volume, which isn't actually something we saw with Coca-Cola that did report earlier in the week. And we can see their adjusted earnings per share is up by around 6% in line with what they've estimated. Now, that is pretty good, around 6%, especially in this industry where we have noticed, like PepsiCo and Coca-Cola, reporting some struggles right across the board with a weakening consumer environment. And also nice to note that at the bare minimum, they have reaffirmed their full-year outlook. So we're talking mid-single-digit increases to the net sales, as well as high single-digit to the earnings per share. So overall, looking fairly solid. Yes, we would like to have seen increasing the full-year outlook. We would have liked to see massive beats, but do understand the type of company that KDP is. Very similar to Coke, very similar to PepsiCo. They are ideally companies that you can rely on for that dividend as well as that continued growth to the share price over time. So in terms of the actual numbers, well, year on year, the sales is up 3.1%. Adjusted operating income, nice to see the mid to high single digit increase of 7.5%. But what we really like to notice here, as we do discuss on every episode and we will cover shortly today, they've also increased their margin. We do want to see an increase in operating efficiency. That is what we get with KDP. And earnings per share, 6.3%. Nice to see that. Remember, for the full year 2024, they are expecting high single digit growth. Now, it's very important when you are investing in companies that you do take a look to see how management allocate their capital. With this company, as we can see and have discussed, they invested just under $1 billion in terms of their investment in the Ghost Energy Drink. They had a very recent dividend increase, in fact last month at 7%. And one thing that's very important, they are thinking about their debt. They do want to lower in terms of the leverage that they have in this company. And as we can see here, a few things that we will again cover, but they do also have a very strong balance sheet. Now, finally, we just want to reiterate their 2024 outlook. As we said, mid-single digit growth to their top line, high single digit to the earnings per share. And also, this is very important, as we will discuss shortly, they are expecting to increase their free cash flow on a year-on-year basis, and this did suffer in 2023, but as we will come to find out, they are expecting this level to come back up. Now let's go back very quickly in terms of this company and their performance. Over the last year, they are still up around 20%. Over the last 5 years, they're up around 26%, and we will show you the last 10 years, especially when we compare it to the S&P and others in the industry. But right now, based on this data, it hasn't accounted for the merger that they had, Keurig Dr Pepper, which essentially composes of two companies. So over the last 5 years, up 26%. They are in terms right now of the mid to upper end of the 52-week range. As we reiterated earlier, triple buy rating, not something we see, not very common, and a forward yield of 2.63%. A forward PE just above 18. Remember, S&P right now trading around 25. In terms of the earnings, while moving forwards, always important to understand, they are expecting around mid to high single digit growth to the EPS year on year, and we do like the fact that over the last 4 quarters, at a bare minimum, they have been in line with their targets, 100% track record, and they do expect growth over the next full year, ultimately lowering that forward PE to 16.93. Now let's get into the metrics. First thing to note, dividend safety score 70. It does look to be safe. Undervaluation on dividend yield theory. Undervaluation, as we can see here on the forward PE. And as we already mentioned, a dividend increase just over the last month. Now safe score reaffirmed on the 9th of August, showing us here that the dividend cut does look to be unlikely. Now the key metric from the last recession, we noticed they had very strong growth in terms of sales. It was above the average at 44% positive, with the S&P during that time negative 12. Now dividend growth, nice to report that 7% above 4% inflation rate in September this year, but over the last 5 years they have been increasing it at the 23% point, but do understand they have in fact cut their dividend over the last few years. It basically got resurrected very recently, and that is why we see here 3 years, although with the increase this month, making it 4 years of consecutive increases. Then we move on to the undervaluation that we note from the forward P, essentially showing us over the last year, based on this model, this company has continued to show some very large signs of undervaluation, and we will run it through our own model shortly as well. And remember, we don't look at any one of these models in isolation. Now, dividend yield theory stating us a company is undervalued when the current yield sits above the 5-year average. So this is one sign of undervaluation. Another sign of undervaluation, the forward P 17.5 below the 5-year of 20.1. So a double signal based on these models. And in fact, you could argue a triple signal given the consumer staples as a sector does sit higher at 18.5. Now, as always, focus on the free cash flow data. Earnings is susceptible to manipulation by management through accounting. Below 70% for the consumer staples sector. Was pretty high in 2023. Not something you pick up on the earnings. This shows us that management paid out more in dividends than they generated in free cash flow. Positive to note here, though, is over the next 12 months, this is anticipated to come down to around 53%. Then we move on to the free cash flow per share, where we always want to see consistent increases over the longer term. We don't get that with KDP, but what we notice here, based on the very small amount in 2023, it is expected to increase, in fact, threefold over the next 12 months. So that is positive, but again, ideally, we do want to see this on a consistent basis year on year. Now, sales growth, they've actually done very well for the industry. When we've looked at companies like PepsiCo, in fact, Coca-Cola yesterday, they have struggled over the last 10 years. In fact, what we notice is over the last 6 years, they have been increasing their top line, 5% in 2023. And as we said, they expect, in fact, in 2024, for the full year, mid-single digit increase to their top line. So looking good in terms of just having that above or at least in line with inflationary increase. And in terms of the numerical perspective, this company has pretty much tripled their top line over the last 10 years. Now, in terms of shares outstanding, they would have diluted your position as a shareholder if you had bought in 2015, but also understand the merger that we did talk about between the two companies. Since that point, though, in 2019, they have done very minimal share buybacks, but again, it will depend at which point you did purchase shares. Very trivial, though, in this point if you are a recent buyer, so nothing really to discuss as of now. In terms of ROIC, this is one area that we would say they lack. We want 12% or more, very important metric. Give us faith, management can effectively allocate their capital. Last few years, around the 6 to 7%, 8% on a trailing 12-month basis. At a minimum, we would like this to settle around the 10% point. Operating margin, we did mention efficiency from the same quarter last year in terms of growth to the margin. What we notice here, though, is above the minimum 16% and has been increasing from the 17 to 23% that we see on the trailing 12-month basis. And the free cash flow margin, whilst very inconsistent on a year-on-year basis, it is at a minimum around the 7% point. Now we get to the final metric here, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 4 for consumer staples. Now we do get that over the last few years, and just to mention, these numbers are the number of years it would take the company to pay off all of their debt net of cash on hand. 3.34 in 2023, expected to go significantly lower to 2.88 in the next 12 months. So a good sign, because this does reflect on the balance sheet strength as well as dividend safety, but we will come to look at that balance sheet very shortly in the episode. Now we want to let you know we have released our latest free weekly article. We deliver one every single Monday morning to your inbox, where we run through undervalued stocks that we do believe deserve your attention, as well as what's gone in the market over the last few days. So do click on the pinned comment below, sign up, and you can start reading straight away. You will also be able to gain access to 36 undervalued stocks for the month of October, running through a lot of information, upside that Wall Street see over the next year, and we also flag those that sit within our own portfolio. On top of that, for the month of October, you can grab 22 dividend stocks that Wall Street themselves believe have the most upside out of the S&P over the next year. So remember, click on the pinned comment below, sign up, and you can read straight away. Insider ownership sitting at around 1%. We see around 2.9 billion worth of sales over the last year. We do see some buys, but very minimal in comparison at 10 million. Over the last quarter, well, no movement. Q3, no movement. We see some selling in Q2, but the bulk of sales and in fact the majority of buys in Q1. Now, for transparency, even though we do believe these are pretty much outdated now, we see an insider sell, or the more recent, on the 23rd of May. Again, information is here. Then moving on to institutions, around 85% ownership. We see around 2 billion worth of sales over the last year, pretty much double the amount of buys there at 4 billion over the same time frame. And we notice in Q3, the more recent quarter, a lot more buying by the institutions, around the same buys as sales in Q2, and a lot more buying in Q1 and Q4 of 2023. So overall, institutions do love Keurig Dr Pepper, a lot more buys over the last year and more buys in the more recent period. Now we're going to jump into some of our analysis looking at the financial statements. In terms of the income statement, we already drilled down in terms of the revenue. It increased pretty much threefold over the last 10 years, from 4.5 billion in 2015 to 15 in 2023. But right now we want to draw our attention to the bottom line net income. Does it tell us a very similar story, a similar pattern? Now you could say yes and no, a little bit of inconsistency on a year-on-year basis, but over the time frame it is moving in the right direction, going from 500 million in 2015, pretty much increasing fourfold to 2.2 billion in 2023. Now, in terms of the health of the company, we already saw the net debt to EBITDA looking okay, expecting to come down. Their cash, very inconsistent as well over the last 10 years. Right now, though, it has gone from 60 million in 2015 to 552 in the latest period, pretty much increasing nearly tenfold. Remember, though, we don't look at these numbers in isolation. It doesn't tell us anything, which is why we compare it numerically and directionally to the total debt, which, as we can see, has increased over the longer term, but has also started to decrease from the highs of 2018, going from 451 million in 2015 to around 14.8 billion in the latest period. So their cash doesn't look that high in comparison to their total debt, but the net debt to EBITDA does look to be okay for now, something maybe just to keep an eye on. Then we move on to some gradings. Now they get a D+ in valuation. What we can see here in terms of the forward P at 18.2, pretty much not far off the sector median of 18, so a very minimal premium in terms of what you were to pay, but we do notice some other valuation metrics, they do trade at a little premium. I think overall, though, you could argue in terms of comparison to the sector, it isn't far off. Then we move on to the growth grade, where they get a B-. Their revenue year on year around 3%, again not far off the sector median of 2.2. Revenue growth forward looking, as we already confirmed, they are expecting that mid-single digit. And what we notice here, again, marginally better than the overall sector at 3%. However, when we do take a look at the earnings per share over the next 3 to 5 years, we can see a very similar theme, 7.7%, not too far off the 7.51. So it does mirror a lot in terms of the sector median in these metrics. When we get to the profitability, though, at a B grade, we see the gross profit margin looking considerably better, 56% versus the 36% of the sector median. Bottom line net income, 15%, again a lot better than the sector of 4.2. Cash from operations looking significantly better, 1.7 billion versus the 777 that we do see from the overall sector. Now, in terms of a quick recap, we got the triple buy rating across the board, fairly rare on this channel, a D+ on valuation, B- on growth, with a B on profitability. Now, a few more things before we jump into the valuation model. Quick comparison against others in the same industry, some very large, well-known names. Over the last year, KDP up 23%. This includes dividends reinvested, one of the better performing as we can see. Over the last 5 years, up 41%, around the middle performer against others. We see Monster doing a lot better. Over the last 10 years, we can see the best performing up nearly 300%. So looking good, but remember, past performance doesn't dictate the future. And we just want to show you that it has outperformed the S&P, maybe not over the last 12 months, but when we do expand it to over the last 5 years, we again see no outperformance. But when you do zoom out over the last 10, that is where we see a large difference. Now look, whether or not you believe moving forwards, whatever your investment time horizon is, that it can outperform, definitely some considerations just to take in place. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $40 today, we've got it through the average of these four models. As we will show you, the first model, Graham's valuation, EPS, long-term growth rate, AAA corporate bond yield, giving us essentially an intrinsic value that gives overvaluation, $27.50, market price now $35. Remember though, we don't look at any one of these models in isolation. Then we have the multiples, companies in a similar sector and size. We have the average P multiplied by the EPS of KDP to give us our first undervaluation signal. We then move on to the dividend discount model where we have the average growth around 9%. Moving forwards, we've gone conservative 5.75, again another undervaluation signal. Then we get to the final model, the DCF model, free cash flow year on year, average growth rate, we've gone a lot lower moving forwards, in line with management target with the 8% discount rate to give us the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we have here, our third undervaluation signal. Now intrinsic value, as we just said, average of these four models, $40 with the current price around $35. As always, we like to use a margin of safety on this channel where we start off with 10%, execute if it meets our 3 golden criteria, wide moat, strong financial metrics, good forward-looking data. Now if you believe that for KDP, we'll buy up to $36, then we keep going till it's near the current trading price, and it's not at that 15% point. What we do notice though, it sits right now between 10 to 15%. At the 15% point, a buy at $34. We'll keep going though to show you at 20% a buy at $32, at 25 a buy at $30. Right now though, sitting somewhere between 10 to 15. And remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for KDP or any other company. We also see here, as we mentioned, a triple buy rating. Wall Street themselves seeing a price target of $41 over the next 12 months. They give upside of 17%. As always though, do give us your thoughts. Is KDP a company that maybe you have bought earlier on in the year, maybe one that's on your watch list, or for whatever reason doesn't fit your overall investment thesis? Remember, 10 to 15% MOS right now. We could see it in fact drop to the 15% point today at $34, and Wall Street themselves do give their target at 17% from the current value. As always, give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We are dropping an article Monday morning, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.